This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes or Apple Podcast, type in Old Dogs, spelled D-A-W-G-S, find our podcast, and subscribe. Well, we have a great show for you today. I'm just going to start with a short little anecdote here. Those that listen regularly know that I used to live in Haiti. And when I went to Haiti, I didn't know the language. The language is Haitian Creole. Although they say official language is French. And I went there with my junior high French and no knowledge of Creole. And we were working with kids on the streets, and it was really frustrating not knowing the language, trying to communicate with them, trying to help these kids out. And I realized, I should have had some sort of a course or something before I went out there, because it hampered me, by months and months and months before I could get some basic things down. And they ended up learning English faster than I ended up learning the language. My kids learned Haitian Creole in 3 months, okay? But I'm an old dog, so I can learn new tricks, but it takes a little longer. So I know the importance of the value of understanding a language. And today we're going to be talking about the language of real estate. And we have a returning guest, one of my favorite guys, I'll tell you, just a knowledgeable guy. His name is Michael Lantrip, and I'm sure you'll remember him. He came on, we talked about 1031 exchanges, and he is an attorney licensed to practice in Texas, North Carolina, Virginia, and the District of Columbia. He is also admitted to practice in the U.S. Tax Court, the U.S. Federal District Court, Eastern District of Texas, and D.C. Court of Appeals. He has a BBA in finance from the University of Houston School of Business, and he has a Juris Doctorate in law from the University of Texas School of Law. He practices in the fields of tax law, real estate law, corporate and business law, and wills, trusts, and estates. As a criminal defense attorney, he has taken 3 cases to the Texas Court of Criminal Appeals, winning 2 of them. As a county attorney, he handled almost 2,000 misdemeanor criminal cases. Formerly a tax examiner for the IRS and a tax accountant for a Big 8 accounting firm, he has also been a newspaper reporter, radio announcer, radio news director, television reporter and anchorman, television executive news producer, and military intelligence analyst. Oh my gosh. I'll tell you. Okay, I'm not done yet. In addition to 35 years of practicing law, he built one of the first computerized abstracts plants and operated his own title insurance company and has been approved a title attorney for 7 national title insurance underwriters. He has handled over 2,000 real estate closings. As a real estate investor, his activities have ranged from travel trailers to office buildings and from on-campus condos to hundreds of acres of land. Prior to his law career, and this is the stuff I love here, he was a radio announcer at WQTE in Detroit during the Motown era, one of my favorite times and favorite music, and he was a DJ at KIKK in Houston when it was named Country Music Station of the Year by Billboard magazine. He has written over 700 stories as a daily newspaper reporter. He has written and produced more than 1,000 half-hour television newscasts, has logged over 8,000 hours on the radio, was named a top writer in 2018 by Quora.com, and is a lifetime member of Mensa. Whew. Man, oh man. And you know, after this bio, after I read it, I go, you don't list how many books you've written and published either. So welcome, Michael, back to the Old Dogs REI Network. How many books did you publish?
Well, I've published 9. I've written 10. The other one I'm still editing. It's not time to do that one yet, probably in the summer sometime. But I've written 10 altogether, working on 2 more, sort of halfway through one and about a fourth of the way through the other one.
I mean, I want to take a nap after reading that bio. No, I'm exhausted just thinking about what you do and what you've done.
I did too. Made me tired just listening to it.
It's incredible. And, you know, you're an old dog, but I'll tell you, I feel much older than you are. And I don't think that technically is the case, but you are always working on something, learning something. It's just awesome. I am so jealous, and I want to be like you when I grow up. I'll tell you right now.
That's about the nicest thing to say, Bill. Thanks.
This is from your most recent book, which has been like right here. It is right next to my desk. I've had it since you were so kind to send it to me. I love this book, and it is great, even for, you know, a vet like me. Yeah, a real vet here, 6 years in real estate. But it's called The Language of the Deal, Real Estate Investing, Vocabulary of Terms, Meanings and Explanations. And this is a great little resource. You do want to have it right next to your, right on your desk, right next to your dictionary. I mean, it's just a critical thing to have. So I am really excited here to hear the 10. Now there's a lot more than 10 in this book, a ton of them, but I want to hear the 10 terms every real estate investor should know. And I'm just going to hand this over to you, Michael, and just let you roll with it. Are you ready?
I am ready. Thank you, Bill. There are actually 85 terms in this book altogether. And I didn't start out writing the book. I started out making a notebook of terms that I needed. I write in a lot of different places, and I use the same reference points. And so I wanted to make sure that I got them all the same everywhere that I put them. So I was putting them into a notebook when I thought, well, if I could just hand this to somebody or put it in a book, I think they'd benefit from it. So that's how that came about. But we have 10 today that I think you'll benefit from. If you use these the way they are supposed to be used, it will improve your reputation as a real estate investor, because it'll show that you really do understand these terms that you're using and what they mean, and that you understand real estate investing. The first one is pre-approved. And this is really a bombshell of a term, because it's used by potential lenders in telling loan applicants the status of their loan application during the loan process. It's to really keep them involved in the process. Pre-approved actually means that you have not been approved. And it also means that there's no reason to believe that you will be approved. The word approved means, obviously, you've been approved. Anything other than that does not mean that you've been approved. If the term means anything, it means that you have provided all of the documentation that is required or has been asked of you up to that point. And the reason that you have not been turned down yet, and also the reason that you haven't been approved yet, is that the person or the committee that will be making the decision on the loan application hasn't even seen your loan application package yet. So pre-approved does not mean that you have been approved ahead of time. It doesn't mean that you've been approved. Now, there is something that you should look into if you are concerned about this. There is a process called a loan commitment letter. It's actually, the heading of it is conditional loan approval. And you can get that from some lenders. Now, most lenders don't want to give you one of those because it locks them in. It is actually a commitment on their part to make the loan, unlike the pre-approved email that you'll get. The loan commitment letter, conditional loan approval, is a document that's about 4 pages long, and it will contain all of the terms and conditions of the approval. And it has 2 sets of requirements for you to meet as the borrower. And those are divided into the what's called the prior to docs and the prior to funding. Now, the first set, prior to docs, means that the lender wants all of this done prior to the time in which they are ready to order the loan documents from the attorney. They want to know that we are at that point now. So you'll meet all of those requirements, and that'll be what you normally do for a loan. Provide a W-2, provide all of the documentation that is required for any real estate loan. And if you provide all of that, then they tell you that you are at that stage, you have provided all of the requirements for documentation, and then they will order the loan documents from the attorney to be sent to the closing agent. We'll use the term title company. Then there's a second group of requirements called prior to funding. And these are the things that you will need to do before they will fund the loan. And that will be things like getting an insurance policy or insurance letter from the insurance company saying they will insure it. It will be getting an appraisal on the property, things like that. And those are all done prior to sitting down and doing the closing. But you satisfy those 2 sets of terms and you will get the loan under a loan commitment letter. It is a binding commitment from the lender to make the loan. And it's considered in negotiations as good as cash. So pre-approval, it can really be a problem. In 16 years creating a title company, I did a lot of real estate closings, and I have to tell you, I have seen people break down and cry at the closing table when their loan was not funded after everything was signed. So be careful with that. Pre-approval, if nothing happens, it looks good to you, but it is not a guarantee. It is not a commitment. It's not even approval. It's okay so far, I guess. But if you want to really be safe, get your conditional loan approval and find a lender that will give you one of those. It's always safer that way. You can lose a lot of money, lose a lot of time, and avoid some really personal crisis by going that route. Bill, any questions on that?
No, I think that's excellent. You covered it very thoroughly. I think that definitely is a misnomer. I think, but the advice about the getting the conditional approval is a smart way to approach it. And as you're shopping for lenders, it's something you might want to ask in advance too.
Yeah. And everything is negotiable. I mean, you hear that saying, but it is true. Let's move on to clear title. And we're talking about title to real estate here, whether or not the owner of the property has clear title. And the fact is, there is no such thing as clear title. In the United States, because of the early land grants, the promoters, the crooked politicians, the illiterate population, and even honest mistakes, every parcel of land has some cloud on the title over the past 240 years. So what we usually get instead of clear title is something called insurable title. In other words, the title company has searched the records for all the documents that affect the title to the property, and they have concluded that although they cannot show that title is clear, they believe that the items that might affect the ownership of that property held by the seller are unlikely to come up. So they're willing to pay the buyer for any loss that he or she may suffer as a result of such an event. So it's not clear title, but it is insurable title. And I've insured a lot of title that wasn't clear. Give you an example. Recently in history, we had people roaming the country who were aluminum siding salesmen, and they would come in and sell aluminum siding to people and sign a contract with them for 5 years, $87 a month, and so forth. That contract would contain a lien on their real estate, and the salesman would file that in the county records, and it would create a lien on the property. And of course, after all the payments were made at the end of 5 years, there was no one around to release the lien because the salesman usually sold it to a finance company, the note, and moved on. And when you made the last payment to the finance company, they couldn't release it because it wasn't in their name, the lien, I mean. So it just stayed there. And so we insured over a lot of situations like that. So that's the difference between clear title and insurable title. You will not find absolutely clear title because it probably could only come from the sovereignty, which was a long time ago. But you have insurable title. And if you use that term insurable title, it'll show people that you are more knowledgeable about real estate, about title matters and so forth. And they will see you as a more knowledgeable real estate investor, somebody that they want to do business with. Bill had a short excerpt about clear title on his website, and you might have already seen that there.
Yeah, on our Friday show, I usually do sort of tips and tricks and terminology. And so I've been, for the terminology side, I've been tapping into your book. And that was one, I just recently covered.
Yeah. Let's move on to something called quitclaim deed. It's spelled Quitclaim, one word, quitclaim deed. Sometimes you'll see it referred to as quick, Quick, and that's just a mistake. It isn't. And in order to explain what a so-called quitclaim deed is, you have to understand what an actual deed is. You may already know it's a person owning property, transferring the property to someone else with a document called a deed. And there are necessary legal elements for a deed. If they don't contain these things, then they're not a deed. The first is a grantor. That's the individual who owns the property and transferring the property. And the second is a grantee, the individual or entity to whom the property is being transferred. The third element is a property description, and that is a sufficient property description to identify the property owned by the grantor to the exclusion of all other pieces of property. And the fourth element is consideration. We no longer put the actual consideration in there. A lot of times the language you'll see is $10 and other good and valuable consideration, which recites for purposes of legality that a consideration has passed from one to the other. And the next is what's called a habendum clause, Habendum, and it explains the exact rights being transferred by the grantor to the grantee, such as to have and to hold and so forth. It's just a legal requirement. And the sixth element is a signature, also called execution, and usually in front of a notary public. And the seventh element of a deed is delivery. The delivery of the document from the grantor to the grantee. And that actually completes the transaction. That property has been transferred when that happens, even though that document has not been filed in the deed records of the county where the property is located. That is not part of the actual transfer process. The purpose of filing a document in the county records, real estate records, is not to complete the transfer, but to give notice to everyone else, to the public, that the transfer has occurred, and now John Smith is the owner of this property. And if you do not do that, then someone else can buy the same property without knowledge that the person who sold it to them had already sold it to somebody else, and you have a problem. That's why you always record those immediately at the courthouse. We could go into a long discussion of that. In some states, we even have a statute that says that you must, in order to protect the title that you've received, record it in the courthouse and give everybody else notice. And those states are called, the laws in those states are called the race to the courthouse statute, because whoever gets that document to the courthouse and files it first is the real owner of that property. Now, to quitclaim deed, from the deed to the quitclaim deed, the reason that I say that a quitclaim deed is not even a deed is that it doesn't contain the elements of a deed. In fact, it actually disclaims the elements of a deed. If you look at a quitclaim deed, there is no basic legal form for a quitclaim deed. There's one that's in general practice. But if you look at the language in it, it begins by saying, I don't even claim that I own this property. So you can see why that's not a deed. And it continues, but if I do own the property, I hereby transfer whatever interest I have or might have to you. So you see, it doesn't even claim to transfer. It doesn't claim to own, doesn't claim to transfer.
Yeah,
so
it's really interesting. Yeah, that it calls itself a deed, but it's nowhere near a deed.
That's right.
Yeah.
If it's anything at all, it's a disclaimer of interest in a piece of property from one person to another. Now, I have, like I say, I don't know how many real estate transactions I've insured, but the only time that I have ever insured one with a quitclaim deed in the chain of title was when I had researched the chain of title, and I knew with absolute certainty that the person who signed that quitclaim deed actually did own the property based on all of the documents up to the point where he signed that and transferred it. Otherwise, you have a gap in the title, and it's very difficult to close. I don't know of any circumstances under which a title insurer could legally insure title with a gap in title caused by a quitclaim deed, because title insurance companies, of course, issue title policies, and they do that for a fee because they are taking a risk. But it's not really up to them. There are a lot of rules that the state has for the title insurance companies. You can't just insure anything you want to. We have certain parameters and certain levels of risk that you have to look at and meet. And if you don't, you can't insure it, even if you want to. So, interesting thing about insurance, title insurance policies, they're called insurance policies, but they really aren't. the title insurance companies are governed by the insurance commission, just like other insurance companies. But most insurance policies, like your car, your house, whatever, insure you against events that might occur in the future, right? A title insurance policy insures you against events that occurred in the past. So it really indemnifies you against what has already happened so that you won't suffer a loss. And that's why title companies will pay you whatever loss you suffer due to a defect in the title of the property. They still are not required to cure the defect in the property. So that's an interesting thing about insurance policies and the difference between title insurance and all other types of insurance policies.
Great. Good information. Good information. Yeah, quit claim deed is the sort of the main tool for wholesalers. That's their main vehicle. They find distressed owner and then come to an agreed upon price, and then they get a buyer on the other side, and in between it all is that quick claim deed. So yeah, that's used pretty frequently in that industry.
It is, and some states have even had to, and Texas is one of them. I think North Carolina has one as well. Has a statute, it's a couple of years old, I think, that says that these are the conditions under which you can accept a quitclaim deed as a valid transfer of ownership. They do not say that it is a valid deed. In fact, they explain that it is not, and that's why they needed this statute. And so because people would not stop using them. They're one page long. You can usually get one free on the internet. So the fact that they don't work didn't stop them from using them. They just used them anyway.
All right. Great. Well, we got 3 done. Let's keep moving forward here. This is great.
Okay. Deed in lieu of foreclosure. This is not a misnomer or a mistake in titling and so forth. It is actually what it says it is. You deed the property back to the owner of the purchase money lien on the property in lieu of, instead of, that lien holder foreclosing on the property. And it usually happens when you are in default or delinquent or whatever. And most people believe, and rightly so, that if I just deed it back, then, I lose the property, but I don't really have any problems related to that. Well, there are 2 problems related to that, and they are huge problems too. One problem is if you deed property back to the lender, the IRS looks at that as a sale of property. And they look at the sales price as not what you owed on the property, what you paid for the property, as the fair market value of that property on the date of transfer. So as far as the IRS is concerned, you just sold that property. Now, why is that a problem for you? Well, it's a problem for you because, let's say 4 or 5 years ago, you bought a 10-unit apartment building for $500,000. You've claimed depreciation on it each year, and now the depreciated basis in the property is down to about $350,000. Well, from 5 years ago, when you paid $500,000, up to now, the fair market value is now $800,000. And in the meantime, you've refinanced it and put the money in your pocket or whatever, and the loan on it is $700,000, and you can't pay it. So you deed it back to the lender. Well, the IRS looks at it and says, you just sold this, fair market value, $800,000. Your depreciated basis in it is $350,000. You just had $450,000 of capital gains. Oops.
Oh, gee.
That is a problem. And they want the money and you don't have it. And that is why you should look very closely at signing a deed in lieu of foreclosure. Do the numbers, get an accountant to help you if necessary, but you might want to do something instead. I have walked clients through talking to the lender in the process, a friendly foreclosure in which you cooperate with the lender all along the way. You know, if it's posted at the courthouse for foreclosure, then you don't object to it. You go along with it. You help him in every way that you can. If it's a state where you have to go to court to do a foreclosure, you don't object to it. You don't file anything and so forth. You let him foreclose on the property. That way you will have a different number to look at. And it gets complicated at this point. Because he will foreclose on it and then sell it at foreclosure. And the numbers that you're looking at are the amount of the debt, the amount of your basis, the amount that the lender got for the property, how much of that was applied to the debt, and so forth. But the number, I promise you, will be much, much lower as far as tax is concerned. And there's a second, somewhat more complicated computation that you also need to know about in a foreclosure, because if you owe $700,000 on the property and the lender takes it back and does not pursue you for the deficiency amount, the difference between what they got at the foreclosure and applied to the loan, and what you still owe on the loan, then that is also considered income by the IRS, that difference. It's called cancellation of debt income, COD income. And it's totally phantom income. You didn't receive it. You just received a cancellation of debt, and therefore you need to pay taxes on it. You know, when you get a loan, that's not a taxable transaction. You borrow the money, you put it in your pocket, you don't pay taxes on it. But if that loan were canceled or part of the loan were canceled, then it would be taxable. And that's where this cancellation of debt income, phantom income, comes in. So you could, in a deed of lieu foreclosure, you could end up with two tax bills, one for cancellation of debt, COD income, and one for capital gains tax, neither of which. Well, the capital gains, in effect, you did receive that income because over time, as you refinanced it, that you were taking out your capital gains at that time and not paying taxes on it because, like I said, it was a loan and it wasn't taxable.
Right, yeah, and especially in these days of forbearance and foreclosures, and just there's a lot of activity, some of it pent up that I'm sure has yet to hit, but that's very valuable information to know.
Let's move on to personal guarantee. This is a situation where you might have an LLC and you might convince a lender to make a loan directly to the LLC to buy the property so that you can put the property in the name of the LLC for personal liability protection. And you personally guarantee that loan. That's a personal guarantee. Well, we tend to think that that's what a guarantee is, but there actually are three types of personal guarantee. The one that we just talked about is a blanket guarantee. It is complete. And if loan payment is late, you could get a call from the lender. That's what a total blanket guarantee is. But there are two other types of guarantees, and I've used one of them. I've tried to use two of them, but I couldn't get the other one. But I've used one of the others, and the two other ones are a standby or backup guarantee, and the third one is a loss, LOSS guarantee. Now, the standby or backup guarantee is where you agree with the lender that the lender will deal with late payments, deficiencies, everything up to the time that he posts the property for foreclosure. And the backup guarantee requires you to step in at that point and pay off his note, if it's at the point of foreclosure, and pay off his note. So that is your guarantee at that point. What you'll normally do is just refinance it if it's your LLC that went into default on it. The third guarantee, the loss guarantee, is one in which you're out of the process altogether. The lender carries all the way through to foreclosure, sells the property, applies the net sales proceeds to the remaining principal balance of the loan. And if there is a deficiency, then you agree to pay that. Now, lenders are sometimes happy with that. They just want to know that they're not going to lose their money. And I know of 2 or 3 large real estate investors who negotiate those types of guarantees if they have any liability at all, if they're required to do personal guarantees. So those are the 3 types of guarantees, and you probably should try to negotiate those if you possibly can before you sign that blanket guarantee.
Now, a question on that. Let's say somebody does have an LLC. They want to they're the sole owner LLC or sole manager, and they transfer that ownership or to 100% to another individual. Now, the property, the name of the property is the LLC name. So that person, would they automatically become the owner of that property, or if there is a personal guarantee on it, or would you have to, does that really warrant ownership if they're the sole owner of that LLC?
There will be language in whatever you sign with the lender dealing with that situation.
That basically says you can't do that without qualifying the new owner.
They generally don't prohibit anything in those in those agreements. It appears to be prohibiting it, but it prohibits it and says without the prior consent of the lender. So it leaves open the possibility that you can do that. And I have done that particular thing once, I believe. And so, yes, it can be done. When you get to the point in real estate investing where you have 5, 6, 7, 8 properties and some of them are paid off, you will have so much flexibility in your financing, you won't believe it. I had one piece of property that I kept completely paid off. And any time that I did any financing, I used that piece of property and then refinanced when I was finished.
Right.
And it was rural land. It was 98 or 100 acres, and so it wasn't anything like there were occupants or had to have insurance on it or anything like that. And the bank was very willing to loan a percentage of it because they knew that the value was there. And so I just had ready cash, and I learned that from other real estate investors that I got to know.
Interesting. Well, I don't want to hold you up. I know you still got 5 more to go here.
Okay, assignment of rents. This is fairly short, and it is generally when you get financing on a real estate income property, the lender will require another document. They slip it in with all of the others called assignment of rents. And you don't know what it is, but what it is that if the payments on your note become either past due or delinquent or in default, whatever those definitions are, and they'll be defined in the document, those terms will be, then the lender can file that document, that assignment of rents, in the real estate records, get certified copies, send them to the tenants, and say, you will now send your rent payments to me. And they will use those rent payments to pay the note. And, that makes sense. That's reasonable. Except you as the landlord are now stuck with all of the expenses and you don't have any income. So look at the language in that assignment of rents document to see whether or not the lender will then take over payment of the expenses or just take the rents and apply to the note, because that could save you or cost you some time and or money.
Good point. Number 7.
A living trust is not a trust. It is a conditional document. It's a document that creates a trust that will come into existence upon a certain condition. In other words, it says this is a revocable trust. Well, the legal definition of a trust is that it cannot be revoked. So it's a revocable trust is not really a trust by legal definition. I know I'll get argument on that, but just look at the definitions and you'll see what I'm saying. Now, a living trust is a revocable trust. There is no trust document anywhere with all of the terms in it and so forth, signed and notarized, filed for anybody to look at. In fact, you just put it in your desk drawer. And the way you revoke it is by taking it out of the desk drawer and tearing it up and throwing it in the trash. Now, does that sound like a trust? A legal entity that is actually a trust? Of course not. Nobody knows about it. Nobody sees it. Nobody monitors it, checks to see if it has everything it's supposed to have. So a living trust is not a legal entity. And a lot of people they deed property to a living trust, which can't legally take title to property. And the reason that it can't is that an entity that takes title to property, there has to be some memorialization or documentation somewhere to show who can then transfer that property to somebody else. You know, you deed property to a corporation, to a partnership. It's easy to find out, well, who can now sign a deed out of that entity to somebody else. Corporation, a president, or whatever their bylaws say. But with a living trust, a revocable trust, there is no document to say who can now deed this property to somebody else. So if you sign a deed into a living trust, it is not a void deed, because a living trust, the language of a living trust, if in fact you do have a document, says that upon my death, this revocable trust becomes irrevocable. And at that point, it becomes a valid legal trust. And that's the purpose of a living trust. You want to avoid having your property go through probate, so you create this thing called a living trust, a revocable trust. Put your property in it. The IRS still considers you the owner of that property. But upon your death, that property automatically goes into that trust, because it is then a valid trust, an irrevocable trust that is entitled to receive title to real estate and to ownership of property and so forth, and will have a named trustee who will manage all of that property. So that's what I wanted to tell you about a living trust. Just be careful with those. You can use them, and they are very useful if they are used correctly, and if everything plays out the way you expect and want it to play out.
Yeah, I mean, they're invaluable here in California, where we have ridiculous death tax laws. I mean, the inheritance structure here, inheritance taxes, is just obscene. So the living trust here, I recommend anybody in this state that owns property to use them for sure.
Okay, abandonment. This is, I put that term in there because I hear a lot of people talking about looking for abandoned property. Like there's this type of property that's been abandoned and it's just up for grabs. I can promise you there is no estate of ownership of real estate called abandoned property. It doesn't exist. Once real estate goes into your name, you own it. You can't just say, "Oop, I'm done here. I no longer own this property." It is your property. It is your responsibility, and you will own that property until you execute a document transferring that property to someone else, or the government takes that property from you for some lien that the government is allowed to impose and execute on, such as a property tax lien or an income tax lien and so forth. Or on the third reason that it might happen is a court in a totally unrelated situation in which a judgment has been entered against you, and the judgment creditor goes to court and says, "I would like the court to order this property to be sold and the proceeds used to pay off my judgment." But you can't yourself disown real estate. Once it's in your name, it stays in your name until you transfer it out or it's taken by one of those two ways. So, and that leads us into the next one, which is adverse possession, because people think, well, if I find property that nobody's living on, I can just go on there and live on it and take it. Well, you can't. Every state has different laws. They're not vastly different. They're similar, but they are not all identical on how a person can obtain title to property by adverse possession. And there are generally anywhere from 7 or 8 to 10 to 12 conditions that you must meet in order to qualify to go to court to ask the court to declare that you are now the owner of the property. And you have to actually possess the property. That's why it's called adverse possession. You have to actually possess the property, either living there or using it on a regular basis. The possession has to be open and notorious. In other words, you can't just sign up for it and come back 14 years later. You have to actually show other people that you are claiming this property and you are preventing anyone else from living on the property. And that means that you also meet the exclusive requirement. And it has to be continuous, meaning that it's uninterrupted. So adverse possession is something that a court, you can't do it yourself. A court can award you title to property by adverse possession. But in order to meet that requirement, it's very difficult. I would say in probably 30 years of researching title to property, I looked at a lot of title transactions. I have never seen property granted by the court under an order of adverse possession. It just almost never happens. One of the ways that this comes up is when people see that their fence is on the adjacent property line. They approach onto other property. They say, well, been there for 10 years. I now own that 3-foot strip by adverse possession. That's not an issue of adverse possession. That's an issue of encroachment or property line dispute. And if you can't settle it, you have to go to court and settle it. And there is usually a document somewhere that will determine the outcome of it. Either you have a surveyor, your neighbor has a survey, or you live in a subdivision that has a subdivision plat that has been filed in the county records. And that's where that question will be answered. But it won't be answered by where the fence has been for the last 10 years. You can have different types of encroachment. you can have a structure on your property, and a fence is also considered a structure that encroaches onto the neighbor property, or the neighbor can have something encroaching onto your property. One of the things that I've heard, well, the corner of his house is sticking over on my property. I can just take a chainsaw and cut it off. No, you can't. The way the way the law works is that if you own the ground, you own anything that is built on the ground. So if your neighbor, for instance, builds a fence over on your property, you actually own that fence. Now, you could probably get a judge if you were the neighbor to declare that it's actually your fence, in which case it is if the judge says it is. But under law, if that's built on your property, you own it.
Got it.
That's how property line disputes usually arise. And by the same token, if you build over onto the neighbor's property, and that becomes a dispute, be nice to the neighbor. He can get up one day and go out and knock that down because it's his.
Gotcha.
Unless the court declares otherwise.
Gotcha. Man, this is great. Great stuff. You know, the thing I like about this book is, I think people have dictionary real estate terms, but they're it's stuff that you may not even ever encounter. This is stuff that I think is real common, that we hear all the time, especially real estate investors. And that's what I like about it. It's written in layman's terms. You really make it clear what it is or what it isn't, that particular term. And that's the thing I really love about this book. And I think everybody listening should get a copy of it. It's not expensive. It's again, you said only 85 words or so, but I think it's the kind of stuff that you need to know. You need to know, especially if you're signing contracts where a lot of these terms are used. And this is really good stuff, Mike. I cannot thank you enough for being on and tackling this with us.
Well, and I really enjoyed doing it because I saw people who really thought that they were saying something that was accurate and complete, and because that's what they were trying to do. They weren't trying to lead. They were saying misleading things because they didn't know. I did the book because, your reputation is all you have. And a lot of times when you're just starting with a new relationship with someone, the only way they have of knowing whether you know what you're talking about or not is by what you say. So you have to be very careful. You have to say it correctly, and you have to use it in the proper context, and you have to relate it to other related matters correctly. And then they say, this guy knows what he's talking about. He understands this stuff. It will help you. Like I say in the blurb to the book, if you increase your knowledge of real estate investing 5%, just 5% each month, in 3 years you'll know 6 times as much as you know right now.
I like that.
And if you do it in incremental terms, a little bit at a time, and you'll surprise yourself how much you know. I mean, think back how much you've learned in the last 3 years.
Yeah.
And that's what it's all about, presenting yourself in a professional manner while you're still trying to learn everything that you can.
Yeah, at the same time. Yeah, you got it. It seems kind of overwhelming, but it's nice, when you can take little bits like you were saying, a little bit at a time,
Mm-hmm.
That'll make you that much more effective. I like that. Well, Mike, I really appreciate you being on. I'm sure there's folks listening that, would love to find out more about you or your books. What's the best way for folks to do that?
I think probably if you just go to my website, michaellantrip.com, I've got all the books right there on the landing page. And I have a real neat app that allows you to just click on the book cover. It opens up and you can read it in 3D. It flips the pages for you. And I put the first 70, 80 pages of each book there. You can read table of contents. You read the bio, read the introduction, and read 2 or 3 chapters and see if the book's something that would help you. Even if not, then enjoy the book. They're all 8. I have 8 of them on there. 2 I haven't put on yet, but go do that. And my email address is on there, and just email me with anything you had to say.
Yeah, and I'll add too. They're also available on Amazon too.
Oh yeah. And on the website, you can buy the ebook there, and I have a shopping cart. You can download it directly, the ebook directly from the website, and I have a link to Amazon where I sell Amazon sells them, the print books.
Yeah, that's great. That's great. Well, Mike, thanks again for joining us. I really appreciate you coming on.
My pleasure. I always enjoy talking to you, Bill.
Likewise. And I also want to thank all our old dogs out there listening. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate it. Please note everything that Michael talked about today. Okay, we got 10 definitions for free you can get here. Everything's presented in our show notes at the Old Dogs website at olddogsreinetwork.com/blog. And you're going to look for the episode with Michael Lantrip. And just so you know, that's LANTRIP, not LAND. It's Michael Lantrip. And that's it. That's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.